Hey guys, Rahul here, trying to make investing accessible and profitable for the average investor. Now, Microcap Millionaires. Microcap Millionaires is a service that I run at Equity Master. I'm in charge of that service. It's a stock recommendation service. And the service crossed a very important landmark the other day. Since its inception, the service is now a four-bagger. Yes. If anyone would have invested rupees 100 when the service started back in 2014, Feb 2014, his 100 rupees would have become more than 400 rupees now. I know this does not sound much, especially against the backdrop of what the stock market has achieved, in the last year and a half. But when you compare the performance with the Sensex, I think it's a very decent performance. Sensex during the same period has gone up by some 155-160% point to point. This service, Microcap Millionaires, has gone up 320%. So that's an outperformance of 2 times. In CAGR terms, this is more than 20-21% CAGR, which I think is quite decent. Especially when you consider the fact that this performance has been achieved despite remaining 50% in cash at all times. That's right. Now, Microcap is a very risky segment of the market, and if you're not careful, all the money that you make in a bull market, you can end up losing it in a bear market. Therefore, you have to have a very sound risk management system in place. And my risk management system believes in having at least 25% in cash in the service at all times. When the markets are expensive, they can go to as high as 75%. So on an average, the service has remained 50% in cash at all times, and despite that, it has managed to achieve a CAGR of 20-21%, which I think is very quite noteworthy, if you ask me. Now, why am I telling you this? Of course, small part of the reason is I want to pat my own back. I'm proud of the performance of Microcap Millionaires, but I think a big part of the reason is to give some amount of credibility to what we are studying today. Of course, as the title of the video suggests, that this video is all about trying to understand a proper sell strategy. What is the right price at which you should sell the stocks in your portfolio? So what I'm going to discuss today is a strategy that has worked wonderfully well for me in practice. It's not just theoretical, it has worked in practice. It's a strategy that I have used in Microcap Millionaires to earn those 20-21% CAGR. And that's why I give you the entire background of why and how this strategy has managed to give me those returns. So just to sort of establish some sort of credibility, so that you take the strategy with the seriousness that it deserves. Plus, the strategy also has sound logic to it. The logic, of course, I'll discuss in the later part of the video. But first, let me just walk you through what sell strategy do I use to sell the stocks, to recommend sell on the stocks in Microcap Millionaires, and how you can implement this for your own stocks in your own portfolio. So, my sell strategy is that when I recommend a stock in Microcap Millionaires, I hold it for at least 1 year. So unless the fundamentals, they worsen a great deal, or I realize that I have made a big mistake, I don't sell a stock, recommend a sell once I have recommended a buy for the next 1 year period. At the end of the 1 year period, if the stock has gone up by 50% or more than 50%, I would by and large recommend a sell on it. So I hold a stock for 1 year and see whether it has gone up more than 50% or not. If the returns are significantly less than 50%, or if the returns are in the negative region, I again hold on to the stock for the next 1 year and see how it performs. At the end of the 2 year period, I exit the stock, no questions asked. So even if the stock is in the negative, significantly in the negative, if it completes 2 years in the service, it goes out of the portfolio. or if it has managed to achieve more than 50% returns over the 2-year period, at the end of the 2-year period, it again goes out of the service. This is to ensure that you don't end up holding a losing stock for a very long period, so that they don't prove to be a drag on your portfolio. People have this habit of holding on to the losers for quite long, but that does not help their case. If you have a loser in the portfolio, if it is down, you should give it enough time to turn around. If it does not turn around in a period of 2 years, then it perhaps time to exit the stock and look at some other stocks. This is what I do in Microcap Millionaires. So I'll reiterate the strategy. If the stock is up more than 50% at the end of 1-year period, now the range could be huge. I have recommended sell on a stock at the end of the 1-year period after it has gone up 535%, 540% in just a 1-year period. I have recommended sell on stocks which have gone up 250%, 200%, 150%. So even if the stock is higher by 50%, I still hold on to the stock for at least 1 year and not try and disturb the momentum or not try and disturb the uptrend. I allow it to keep going higher for at least 1 year. And if at the end of the 1-year period I feel that the stock has gone up more than 50%, it has gone up say 100%, 200%, I recommend a sell on the stock. And if it's a losing position, I do not hold the stock for more than 2 years. Most of the stocks, 95-96% of the stocks, only in the rare cases I held on to the stock for more than 2 years. Otherwise, almost all the stocks move out of the portfolio at the end of the 2-year period if they are underperformer or if they perform at 50% or below 50%. Otherwise, if they go up significantly higher right at the end of the 1st-year period, they move out of the service. Now, what is the logic for this? The stocks that I end up recommending in Microcap Millionaires, I would call them above average stocks. Stocks which have historically generated ROEs in the region of 12 to 15%. They don't have a lot of debt on the balance sheets. They are not very high quality stocks. By very high quality stocks, I mean stocks which have generated ROEs of 20% or more consistently in each of the last 10 years or most of the last 10 years. Those are very high quality stocks. And if your strategy involves or if your strategy is all about investing in those highest quality stocks, then maybe the strategy that I had discussed is not the right strategy for you. You need to have a different strategy, maybe a buy and hold strategy where once you invest in a very high quality stock at reasonable valuations, you continue holding on to the stock for 1 year, 2 year, 5 year, 10 years if the fundamentals are intact and you think the business is going to be around for many years in the future. So this strategy is for average businesses. It is not for extremely high quality businesses. Neither it is for poor quality businesses, stocks which I feel are largely speculative in nature, where the business quality is very bad, the company has incurred a lot of losses historically, maybe they have a negative net worth or balance sheet is full of debt. Those are speculative stocks, and I don't think you can value those stocks, arrive at a valuation that you're comfortable with for those poor quality stocks. And as far as highest quality stocks are concerned, this sales strategy may not apply to them as well, and you need a separate sales strategy. My sales strategy is suitable for businesses which are in the middle. They are not as bad as poor quality businesses, not as good as good quality businesses. They have ROE of an average 12 to 15%, and which are growing at the rate of the GDP, or which are not growing but at least maintaining their earnings. So these are the kind of businesses I look at. And when you invest in such businesses, these businesses are mostly worth 1 to 1.5 times book value, or 12 to 15 times their earnings power. So my idea is to buy such businesses when they are available at least a 30 to 50% discount to their book values, latest book values, or they are available at a single digit price to earnings multiple, where the upside is in the region of 50 to 100%. since I'm looking for a stock with an upside of only 50 to 100% in above average businesses, I have that as my selling criteria. I recommend stocks which for which the intrinsic value is say 100 rupees. I try and recommend the stock where it's available at rupees 70 or below, so that the upside is 50 to 100%. And that's why I have that sell criteria of stock at least achieving a 50% return at the end of the 1 year period. Of course, there have been cases where the fundamentals of the industry have changed for the better, or the fundamentals of the company have changed for the better, and I have not ended up making 50, 100%. I have ended up making 150, 200, 500% returns on those stocks, because investors have suddenly started to become very optimistic about the company, and they ended up rewarding it with rich multiples. So that's the sell strategy that I have and that I've used so successfully in Microcap Millionaires, of at least a 2-year holding period or at least a 50 to 100% gains. Strategy, as I said, is applicable for average quality businesses and not very high quality businesses or not very poor quality businesses. Of course, there have been cases where I have regretted my decision of selling a stock too early. A classic case is Navin Florin, which I recommended in 2014, which I sold at 170% gains at the end of the 1 year period, assuming that I am a rock star. But that was not the case. The stock went on to multiply another 65-70 times after I recommended the stock. So that was one of the biggest misses, if you can call that. But selling is an art, it's not a science. There will be cases where you will repent your decision of selling a stock too early, but as long as you're having a sound sell strategy that is allowing you to sleep well, that is allowing you to make those 20-25% returns in the stock market, I think you should be fine. So if your portfolio has certain average quality stocks, maybe you can implement the strategy that I highlighted, the sell strategy that I highlighted. It has worked well for me historically. There is no reason why it should not work well, because it's it's proven itself out there in the real life. It has proven itself. It has had practical applications for me, and the logic behind it is also sound in my view, where you're looking for an upside of 50 to 100%. So yeah, that was what today's video was all about. Do keep sending your comments, your feedback, your likes, your dislikes. It allows us to understand the kind of content that you're liking and the kind of content that you're not liking. So keep that feedback coming in, and I will see you around next time. Thank you so much.
Want to make potentially life-changing wealth by investing in path-breaking companies in their earlier growth phase? Then click here right now.